Well, so today magkakaroon na naman po tayo ng accounting tutorial at dahil maulan at sinuspende ni Yorme ang pasok, gawin nating productive ang araw na to. Tayo na mag-accounting!
So, bago tayo mag-proceed sa ating accounting tutorial, nag-ask kami ng students sa National University about this topic that we will be discussing. So, let's watch this.
So, ngayon may idea na kayo kung ano yung itatopic natin. Ito yung accounting standard na tinatawag na PAS 12.
Accounting for income tax.
So, ang tanong ng bayan, is income tax an expense? Some people say it is not kasi nga nandun na yung word na income. So, parang distribution of income lang siya. Just like dividends.
But some people, or must say, most of people say it is indeed an expense. Why do you think so?
Oo nga, bakit nga?
According to the Intermediate Accounting Volume 2, 2017 edition by Employer Robles, that the strongest argument for treating income tax as an expense is that our government provides services to a business entity by implementing rules and regulation, and this will be contribute to an orderly and smooth function of conducting a business. So, income tax is indeed an expense.
The objective of PAS 12 is to prescribe the accounting treatment for income taxes. It also clarifies the principal issue in accounting for income taxes, which is how to account for the current and future tax consequences of the future recovery or settlement of the carrying amount of assets or liabilities recognized in the entity's financial statements. Here, if the future recovery or settlement will make future tax payments larger or smaller than they would be if such recovery or settlement were to have no tax consequences, then an entity must recognize deferred tax liability or asset. Second, transactions and other events of the current period recognized in the entity's financial statements. IAS 12 requires accounting for current and deferred income tax from certain transaction or even exactly in the same way as the transaction.
Accounting income is a pre-tax profit computed based on the requirements of accounting standards and the definition, recognition, and measurement criteria in the conceptual framework. It is the net income for the period before deducting the income tax expense and the income appearing on the traditional income statement. It is also known as financial income and sometimes called pre-tax financial income. Taxable income is derived based on the regulations of the tax code and the taxing authorities. Like in the Philippines, the rules and regulations established are based on the provisions of the National Internal Revenue Code or the NIRC, and the other regulations is coming from the Bureau of Internal Revenue or the BIR. The differences exist between the accounting income and the taxable income are the permanent differences and the temporary differences.
Permanent differences are items of revenue and expenses that are included in either accounting income or taxable income but will never be both included in accounting income or taxable income. It doesn't give rise to deferred tax liability or deferred tax asset because there is no future tax consequences. But it pertains to non-taxable revenue and non-deductible expenses. Non-taxable revenues are also called tax-exempt revenues. These are included in financial income but will never be included in taxable income. Examples of non-taxable revenues taxable revenues are to be deducted from accounting income, while non-deductible expenses are to be added back to accounting income. To fully understand what I am saying, let's watch this example.
According to past 12, paragraph 5, temporary difference may be either taxable temporary difference or deductible temporary difference. Taxable temporary difference creates deferred tax liability. Deferred tax liability are the amount of income taxes payable in future periods. According to past 12, paragraph 15, deferred tax liability shall be recognized for all taxable temporary difference. While in deductible temporary difference, it creates deferred tax assets. Deferred tax assets are the amount of income taxes recoverable in future periods. According to past 12, paragraph 24, deferred tax assets shall be recognized for all deductible temporary difference. To recognize taxable temporary difference, there is two perspectives. Number one is balance sheet perspective, and number two is the income statement perspective. In balance sheet perspective, the carrying value of an asset must exceed its tax base, or the carrying value of the liability must be less than its tax base. While in the income statement perspective, accounting income must be higher than taxable income. To recognize deductible temporary difference, there is two perspectives, the balance sheet perspective and the income statement perspective. In the balance sheet perspective, the carrying value of an asset is less than its tax base, or when the carrying value of the liability exceeds its tax base. While in income statement perspective, the taxable income is higher than the accounting income.
To measure deferred tax liability, the cumulative amount of taxable temporary difference is multiplied by the tax rate, and that is recognized in the statement of financial position.
To measure the deferred tax asset, the cumulative amount of deductible temporary difference is multiplied by the tax rate, and that is recognized in the statement of financial position. So that's it, guys! We hope that you learned something from our tutorial video from our blog about the basics of Past 12 Accounting for Income Tax.
Sana na-enjoy nyo yung video na to, no? Kahit basic lang to, sana may na-impart kaming knowledge,
Yes.
knowledge sa inyo about
Sana
income
makatulong.
tax. Yes, sana. Good luck sa ating mga BSA students.
Yes, laban lang, future CPAs.
Yes.
And we always hope na sabay-sabay nating mahalin ang income taxation.
Yes.
So, marami pa kaming aaralin. And we have to say goodbye.
Yes.
Kung may gusto pa kayong
Another vlog about
yes, just
accounting.
comment below
Yes.
and subscribe
Yes.
and like this video.
Thank you.
Bye.
Bye-bye.